afternoon, everyone. My name is Sriram from the Commodity Research Desk at Reliance Securities. Welcome to the weekly commodity market updates. So beginning with the bullion side of things, international spot and domestic futures along with the COMEX futures ended with gains last week as the US dollar and the benchmark bond yields weakened on the increasing likelihood that the US Federal Reserve may start cutting rates as early as March next year. Inflation numbers in the US have been slowing or coming down from the peaks, and this has definitely increased the likelihood of a rate cut as early as March. Traders are still pricing in a 77% chance that the US Fed may cut by about 25 basis points in the month of March. So this was the primary reason why gold and silver remained elevated last week. However, most of the markets were shut last week on account of holidays, and so volumes were pretty low, but still gold and silver managed to eke out small gains. Looking ahead, the central banks meetings will be the theme of the year. In 2024, we see rate cuts, especially from the top central banks. We expect rate cuts from the US Fed along with the European Central Bank and the Bank of England. The inflation has definitely eased, which can prompt the federal banks into action and start cutting rates, and that will be one of the primary supporter of the markets going forward into 2024. This week we have the non-farm payroll numbers, which will be a key trigger and will provide clues on the Federal Reserve monetary policy outlook. Along with the non-farm payroll numbers, the FOMC minutes of the recent meeting will also be released this week, and that will be the key trigger for the markets. Ahead of the non-farm, of course, we have certain data like the jobless claims and the ISM non-manufacturing PMI numbers, which will also move the markets at least in this week. On the charts, so we feel markets will remain range bound ahead of that. And on the charts, we feel COMEX gold futures February contract can remain within a broad trading band of 2025 on the lower side to 2115 on the upside of things. Domestically, we see a big range as well from 63,000 on the lower side to 63,800, 63,850 on the upside of things. Moving on to the crude oil side of things, international and domestic oil prices were range bound last week but gave up gains to finally settle in the red. Prices, of course, started with gains amid attacks on the ships in the Red Sea prompted fears of supply disruption. Of course, hopes of interest rate cuts after the recent numbers has also supported the markets. The inventory data also remained supportive after the inventory declined last week by about 6.321 million barrels. So overall, initially prices were firm, but again crude and domestically and internationally gave up all its gains to settle down by almost 2%. Again, the supply disruption fears in the Red Sea eased and pull the prices lower, and overall demand still remain on doubtful side as broader risk aversion in the market kept investors away from the crude oil side of things. So we saw a correction from the highs of last week. Again, coming ahead in the this coming week or so, we see prices remaining range bound. Weak global growth concerns will cap demand and keep upside limited. However, ongoing geopolitical concerns in the Middle East will cap downside in the market. So again, we see a further range bound price action for the crude oil at least this week going forward into the non-farm payroll numbers. So overall markets will remain range bound. Trading band will remain between $67 on the lower side to $73-74 on the upside for the international NYMEX. And domestically, we see a broad trading band of 5,600 to 6,200 on the upside of things this week. So, of course, markets will also be looking ahead to the inventory numbers this week, and any surprising data will definitely move the markets this week. Finally, on the base metal side of things, starting with the copper side, prices remain again range bound last week. Initially, prices remained upbeat after Chinese data showed specifically that their manufacturing activity remained upbeat or improved last month. China's November industrial profits also posted a double-digit gains as overall manufacturing in the country improved, further supporting prices. Prices, however, after the initial jump, gave up all its gains as investors booked profits from the year-end holidays. Also, slight recovery in the dollar index also weighed on sentiments and kept any meaningful upside limited for base metals. Looking ahead for the coming week or so, copper and other base metals can remain range bound. Acceleration in China's grid spending could support prices. Data last week released showed that grid spending in China improved by almost 6% in the first 11 months of 2023, following a 1.2% rise in the previous year in 2022. Again, prices also can be supported amid concerns of tight supplies as investors remain cautious about the supply outlook going forward. Of course, the sentiment towards copper looks positive right now, but high prices in the coming few days can weaken demand. So, demand will be the key driver this week and possibly in the next coming few weeks as well. The lunar calendar holidays or lunar calendar trading is expected from China going forward in the next couple of weeks, and demand will resurface at lower levels, and that can cap downside for the markets. But the markets can track the data points going forward. The noteworthy data point this week will be the non-farm payrolls from the US and ISM non-manufacturing PMI numbers, and that will move the markets. Of course, the FOMC minutes will also have a small impact on the market. So markets will look ahead to the data point and will remain range bound ahead of that. On the charts, we see MCX copper January contract on the domestic side remained between 720 on the lower side to 740 on the upside of things. So that's it from our side. Thank you very much for watching. Have a pleasant week ahead. Thank you.